right, ladies and gentlemen, welcome to the options webinar. Today is February the 2nd of 2021. My name is JC Peretz, and I am joined by my esteemed colleague, our chief option strategist, Sean McLaughlin. How you doing, my man?
If people could only have heard the conversation we were having just a few moments ago, they would understand why I'm laughing about that intro. We had some guru talk earlier, which makes me blanch a little.
I'm the Michael Buffer of technical analysis. All right, so we're going to talk about 4 different strategies. Let's get into real quick. I know there's some people here who are unaware of who you are. If you don't know who Chicago Sean is, I don't know where the hell you've been the last decade. I'll give a quick intro first, and I'll let you take the mic. Guys, I'm JC Peretz. I had a little baby girl 6 months ago. I'm the luckiest guy on planet Earth. I outkicked my coverage, married the love of my life a couple of years back. I don't know what she sees in me, but we'll take it. One for the good guys. I'm a technical. What do you have to say there, Sean? Go ahead.
Nothing. Continue.
So we help the biggest, pretty much all the biggest institutions in the world. Maybe not all the biggest institutions, but pretty much every major bank you've ever heard of. A lot of the big hedge funds that are household names, they're clients of ours. We help them manage risk. We help them identify trends, both in the U.S. and around the world. Stocks, commodities, currencies, forex, all of that stuff. It goes through allstarcharts.com. I mean, I think I was counting the other day, certain clients. I mean, our AUM from our clients got to be pushing $1 trillion. Not even counting the banks and stuff like that. It's really, really interesting. And for fun, I am a certified sommelier. So I am like the CMT of wine. I passed that exam. How's that for an intro, Shawnee?
I have a little jealousy there of that sommelier business. I think that's cool. Cool little side habit of yours, hobby of yours. I like that.
All right, Sean, take the mic. Tell these people who you are and why I get so excited to talk to you about options and why they should be. Who the hell are
you? well, the first bullet point there, I just had to, match you there. So I had to do, be a husband and a father, exclamation point, just to be like you. My boy's 6 years old and amazing little man. He wants me to play football with him every day and it's exhausting. But other than that, it's great. I started trading in 1998, JC, even before you, I believe. I started out trading stocks at a prop firm in Tampa, Florida. And we were doing, or at least I was doing personally, hundreds of thousands of shares every trading day. Definitely making my broker rich, that's for sure. The commissions were out of this world at that time. From that, a few years later, in early 2002, I moved to Chicago to become a member of the Chicago Board of Trade, where I was then trading futures, and I ran a small hedge fund where we were doing trend following strategies in futures. And during that time, I'd always been interested in options, and I had always traded options from the beginning when I started in '98. But it was sometime around 2004, 2005, where I really started to buckle down and make options a focus of what I do. I was drawn to the fact that options give me options, JC. It's trite to say it, but options give you a lot of different ways to express your bullish or bearish or neutral opinion in the markets, and that always captured my interest. It's like putting a puzzle together. I know you like puzzles. And that's definitely what drew me. Later on, I became the director of community over at StockTwits, working with Howard Lindzen and Phil Pearlman and all of our buddies over there. We all have a lot of mutual friends there. Did that for 7 years. And the thing that really, JC, of all the accomplishments in my life, I think the thing that I'm most proud of has to be finishing second place in my elementary school 4th grade spelling bee. I mean, come on. And there's no shame in second place, JC, because I'll tell you why. The kid who finished in first place, he is now the professor of linguistics at University of Michigan. So I feel like that's a good guy to lose to.
All right, so I like how you use your Match.com profile picture there. That was good. I like how you did that.
You feeling it? You feeling it?
All right, so let's talk about it. Everyone's getting antsy. They're like, "Go on, JC, let's get into the strategies." Well, nobody cares about Sean's kindergarten spelling bee. All right, so here's how I look at it. When we talk about option strategies, when you think about any market environment, and by the way, there's a common misconception that options are riskier and options are riskier than stocks. And to be clear, they certainly can be if you want them to be, right? Like if you need the juice, there are option strategies that'll give you the juice and it'll make it riskier. But the truth is, most option strategies, correct me if I'm wrong, at least the ones we use, are can be more conservative, or because we can get the same exposure in the stock market with a smaller position. So technically you're getting the same exposure with less money. So doesn't that make that more conservative, right?
Yeah, well, I think where the misconception lies is that people see that if I were to buy a call option or a put option, that you have the risk of losing 100% of your investment. And losing 100% of your investment sounds scary. That sounds risky. But it comes down to smart position sizing. You don't put your whole portfolio, JC, into a long call option. I don't care how bullish you are, or how sure you are that you're right. That's just irresponsible, and you will blow up. I mean, it's only a matter of time. So I think there's that misconception there. Options, when used selectively, when used in a risk-defined way, and position sized properly, they can be far less risky than trading stocks.
So for, this is kind of common sense, really sort of environments. Granted, there are some range-bound markets that you could take advantage of as well, but let's just focus on these four. I mean, if you nail these four, you're pretty much good to go. Like you can find environments and strategies moving forward. So you could be bullish a stock in a low volatility environment. You could be bullish a stock in a high volatility environment. You could be bearish a stock in a high volatility environment. And then rarely, but it does happen, you can be bearish a stock in a low vol environment, right?
You got it.
All right. So everybody stay to the end. Sean and I have been working all day looking for a nice trade. We might even give you a second free trade. I don't know. We're just going to have to wait and see. But stay till the end of the event, and we have something nice and sexy for you. This one I had to show. We're not going to go through testimonials here. This is the only testimonial, but I did think it was funny. This guy tweeted out, Peloton was one of our best trades last year, maybe the best trade last year. And Aaron says, what do you do with the 4,000 in profits that Sean and JC gave you from buying Peloton? October 60 calls, you buy your wife a Peloton. Isn't that hilarious?
Thank you, Aaron. Your check is in the mail for that glowing testimonial.
Oh my God, it's hilarious. All right, so this, guys, if you guys are paying attention, save this, print it out, frame it, whatever you got to do. But this is a great resource because it could get confusing. It's like, oh my God, do I put on a risk reversal or a bear call spread or a calendar or straddle? What am I going to do? Right. So you want to ask yourself, right? Are you bullish? Are you bearish? Is it a high vol environment? Is it a low vol environment? Anything you want to add to this? I mean, it kind of speaks for itself, but any notes here?
Yeah, well, this little graph here, this is not an all-inclusive map here. I mean, there's certainly more strategies that you can employ, but I listed these two for each quadrant because these are really my go-to strategies. These are the ones that I use most of the time. There are certainly other strategies, and we could talk about them in other ways, but these are the most common ones that I use.
And it's simple, right? Two quick strategies. Use this as a resource anytime you're kind of wondering, maybe you get stuck, emotions are flaring high and you kind of lose track of what you want to do. You can always come back to this and be like, okay, I'm bullish, the low volatility environment. I could just buy calls, call it a day, no pun intended, or maybe some long straddles, for example, right? All right,
Exactly.
Let's get it. 4 environments, right, Shawnee baby? 4 environments. The first one is, I gotta tell you, I mean, I don't know if it's everyone's personal favorite, but I kind of really like this sort of environment. Bullish, low volatility, reminds me of 2017, don't it?
It does. And, at the risk of immediately turning off our customers who came here to this webinar looking for, complicated, exotic strategies, we're going to hit you right out of the gate with the very epitome of keeping it simple. And
Bullish,
the first trade,
environment, right?
yeah.
Simple.
So the trade that I like to do here when I'm bullish in a low volatility environment, and I should kind of lay out the case that when we're bullish and there's low volatility, oftentimes that means the stock that that we're thinking about putting a trade on is usually at or near all-time highs, or at least some kind of major high. And people generally aren't scared when a stock is trading near its highs. So volatility is cheap. The options market's not, nobody's trying to protect themselves in that kind of situation. So low volatility presents itself very well. And man, and those setups, JC, I know you do, and I certainly do. I love buying stocks making all-time highs because there's no ceiling. There's no place the obvious place that sellers are waiting to get out. And for a stock to go from $10 to 100, it's got to make a lot of all-time highs along the way. And in those situations, why get in our own way? Let's just buy some calls and let's get on with it. And there's unlimited upside when you do that, JC. So yes, there are complicated ways to make options, and we're going to talk about some spreads coming up in a little bit. But JC, you know it. My favorite options trade in the whole world is just buying calls.
And let's talk about best practices, right? Because everyone's like, well, any idiot could buy a call option. Well, first of all, we want to buy call options. Just call it a day and buy call options when volatility is cheap. And one of the questions coming in is, how do you define low volatility? One thing I've learned from Sean is that we don't want to compare volatility historically going back decades. We want to look back over the last 6 to 12 months, correct?
You're right. And there's two things I want to point out. When I'm talking about low volatility, I'm talking about stock specific low volatility. I don't care about the whole market. The stock market as a whole might be really volatile right now. That doesn't really matter to me so much as I want to know what is being priced into this particular stock. All right. And most importantly, where is the volatility that's being priced into this stock compared to where it's been over the last 6 to 12 months? If it's at the low end of the range, I don't care about the actual volatility score. It's like there's a lot of complicated math that goes into the volatility score, and you're going to get all kinds of weird numbers, and you can't compare apples to apples. You can't look at the volatility score of Amazon and compare that to, I don't know, some $10 stock. It's not going to tell you the same thing. All I care about is where is stock XYZ's volatility now compared to where stock XYZ's volatility has been over the last 6 months. And if it's low, if it's at the lower, say, third of that range, then I consider that low volatility, and that's an environment that I like to buy calls.
All right, couple of things that I want to point out. Number one, premiums are cheap, right? So the idea is to take advantage of that cheap volatility and go out as far as you can, because they're basically giving away time. They're just, right? They're making it rain time. So you might as well take advantage of that. And if you can go out a few more months longer than maybe you normally would, you might as well, right?
You're absolutely right. And JC, when I see a stock that's setting up that we like, and it's like just below or right at all-time highs, and the volatility is extremely cheap, I start licking my chops. I'm like, all right, how far out can I go? Can I go out a month? I mean, can I go out 9 months? Can I go out a year? Like, I want as much time as I can because it's so cheap to buy it right now. It's almost irresponsible not to give yourself as much time as possible for a major trend to develop. So much to love about buying calls in a low volatility environment.
Licking your chops. Aren't you a vegetarian? Okay, let's
I
talk about best practices. So when we're buying call options, so it's not just YOLO calls and set it and forget it, right? That's not what this is. There's a plan, right? So first of all, from a risk management standpoint, the most you can lose no matter what, the world can come to an end tomorrow, the stock can go to zero tomorrow, no matter what, you can't lose more than the premium that you paid. So risk management is already implied, right?
Yep, risk management is already built into the trade, so that's the good thing. But it's important to make sure that you size that trade with the expectation that there's a real possibility that you could lose 100% of the premium in the calls, and that's okay. A good rule of thumb that I use is I don't like to risk more than 1% of my trading capital on any one trade. Some people like to do 2%, but I wouldn't go beyond 2%. Once you start getting beyond that, then you're getting into dangerous risk management territory. But I'll buy as many contracts as I can buy, such that I'm not risking more than 1% of my capital. That's
all right.
number
one. And we're taking half off the table on a double.
Right. So this is one of my best practices. I'm not saying this is the best practice, JC, that
The best,
everybody should do, but I'm telling you what works for me and it works for me well.
the
Is
best.
that anytime I buy long calls, whenever I'm fortunate enough for those calls to double in value or more, but as soon as I have a double in value, I always look to sell half of my position. So let's say I bought 10 contracts when I got into the trade and I bought them for $1 a piece. If they're now trading at $2 a piece and I've doubled my money, I'm going to sell half of my 10 contracts. I'm going to sell 5 of them at $2. And what that does, JC, that gives me all of my original risk capital back, safe and sound, tucked into my cash account. Market can't take it from me. And I'm still holding half a position that I no longer need to worry about. I don't have to stress about the volatility that, look, if a stock's going to have a major run, which is why we're in this trade in the first place, if we're going to have a major run, you have to expect that there's going to be some swings. A stock doesn't go from $100 a share to $200 a share without a $50 pullback at some point in there. It's inevitable. It almost always happens. And so by taking my original risk capital out of the trade, it gives me a lot more comfort to ride out what is sure to be some volatility coming down the road.
And you want to have that feeling of regret that you sold half. Like that's a feeling you want to get, because if you get that feeling, that means you're killing it, right?
Right, and you bring up a good point there, JC. And we're going to talk about a trade here in a second that we did. And look, when you hit a home run on a trade, when you get a stock, for example, that you got in when it was at 100 and the thing goes on to 200, you're going to kick yourself for having sold half your position for what then will look like a meager sale. You're like, oh, I could have made so much more money. Yes, you're going to have that feeling. I have that feeling all the time. But I promise you, if you do this enough times over enough trades, you will come out ahead, because what ends up happening is a lot of those stocks, a lot of those runs where you sold half when it doubled, a lot of those runs run out of steam. They either reverse or they just stop going up, and the calls end up expiring worthless or going out with a very little value. And you're going to be happy that you did that, because I promise you, and I'm the proof of it because I see it in the results that I have, is that over time, selling half is a net winner for me. Yes, I'm gonna feel like crap when I see a stock just scream higher for 1,000%. Yes, I'm gonna be mad I'm not gonna be mad and I'm gonna have FOMO like crazy. But I'm telling you, the numbers work out. It's a best practice that pays out over the long run.
There's so many benefits from it. Number one, the math works in your favor for sure. I've seen it a zillion times. Number two, having those emotions of FOMO just makes you human. If you didn't have those emotions, that would be inhumane, right? So those emotions are perfectly normal from a behavioral finance standpoint. It's stopping yourself from acting on those emotions that separates the winners from the losers. Recognize that that emotion will come. In fact, look for it. Look forward to it, because those emotions are coming. That means you're making a lot of money, right? So that's a good thing. Number one. Number two, the risk management's already implied. And then finally, this is the sort of the theoretical P&L graph. I mean, it's a long call option, so like it's not really that complicated. The stock goes up, you're going to make a lot of money, right? So that's what what we're talking about here. The strike price will be on the x-axis. The y-axis is empty because it's profit. So the further up it is, the more money you're making, and the further to right it is, the further the stock is going up. So that's your P&L graph, right, Sean? Any other details you want to point out here so that
Yeah, let me just do a quick riff on, you see 25 delta in parentheses there. So a best practice, and I get asked about this all the time. I generally, when I'm buying long calls, I generally like to buy the 25 delta call. 25 delta, what that means, if you're not familiar with that term, 25 delta means that approximately for every $1 move in the underlying stock, the value of the option will increase by approximately 25 cents. Okay, so if the stock goes up $1, then the value of the option goes up 25 cents. Now, I like to use the 25 delta options because, to me, in my opinion, it gives me the perfect mix between affordability, because it's slightly out of the money, it's going to be cheaper than, say, an at the money call, and it gives me leverage when I get it right. So when that stock, if I time my entry perfect and it starts ripping like this Peloton that you can see on the screen, you get a lot of leverage out of that 25 delta call, and your percentage return on that investment is much greater, dramatically greater.
And the reason that I want to show the Peloton chart is not so much because we got it right, because there were probably there were a lot of call options that we got right last year. Like if there weren't, you probably did something wrong, right? But forget that. The reason I want to show Peloton specifically, it's because it was one of the rarest situations ever where we were able to hold it until the very last day. But the reason I want to reiterate why we were able to hold it until the last day was because we had taken half off the table. So it was all house money. That's the key.
That's absolutely it, JC. And yeah, Peloton was one of those rare situations, like you said, that we were able to hold it all the way to expiration day, and we exited reluctantly on expiration day. That thing was just, I thought it could go another 50 bucks. It turns out, in hindsight, of course, we couldn't have known it at the time. Expiration day turned out to be a short-term top in Peloton, but that's an accident that we got out at the top, of course.
Yeah, of course. I mean, that's not really the point. The bigger point was that we were able to sell it the day of expiration, but you wouldn't have been able to hold it that long had we not sold half. A couple of questions coming in, regarding the risk management here. As we mentioned, risk management in the call options is already built in because you can't lose anything more than the premium that you paid. But in addition to that, we will outline levels where say, hey, if we break this level, all bets are off, and let's just keep whatever else we can get. So you're not even risking 100%. It might be more like 50 or 60% of that particular position. So you want to position size accordingly. But even if it goes to zero, you still can't lose more than that. But even within that, we could still manage risk a little bit more as well, right?
Yeah, absolutely. I don't want to lose 100% on the calls that I get wrong, for sure. And we do identify levels where clearly, if this level breaks, that tells us that our trade thesis is no good, is no longer good, and I will look to exit the position and salvage whatever I can from the trade. I don't want to take 100% loss, but I make sure that I size my position such that if that happens, it's not the end of the world.
Yeah, because going into the trade, we're already assuming that stock's going to zero tomorrow, right? You're going into the trade assuming that's going to happen, and you're okay with that, right? So if we can salvage a little bit, it's just an extra little couple of bucks. We'll take
Well,
it.
that's a good meta thought there, JC. I'll take the other side of that. I don't assume a stock's going to go to zero, but I also go into every position not thinking this is going to be my home run trade of the year, but sometimes it is. Like I don't have that expectation of this is going to be the big winner. I just try to keep an even keel on every trade and just try to do as many as we can.
See, that's where you and me are different. Every trade, I assume, is going to blow up in my face. Like, I don't care how high I think it's going to go. I want to know where I'm wrong and how much I could lose. That's my biggest thing. So with call options, I don't even need to think about it. All right, let's move on. Call options, a lot of us know it. I like the best practices, though. So for you guys that are like, all right, call options, big deal. The best practices of that particular trade, oh my God, I can't emphasize enough how important that is. All right, now, we're still bullish, right? So this is environment number 2, still bullish the stock, except in this case, it's not a low volatility environment. Volatility is actually high. So what are we going to do? Riskies, huh?
Well, in scenarios like this, my favorite trade to put on is a bullish risk reversal, where we are selling an out of the money put and using those proceeds to purchase an out of the money call. And ideally, we're doing that for a small credit. Now, we're not trying to be greedy with a credit here. It's really just so that out of pocket, we're not spending anything. So if I could sell a put, let's say for $2 and buy a call for $2.10, excellent. That sounds, let's keep it even. And I love this trade because when volatility is high, I don't want to just buy a straight call because the options market is going to make me pay for it, right? They're going to make me pay more than I want, which lowers my probability of success because that just means the stock has to move higher for me to be able to recoup the premium I paid. So with a bullish risk reversal, I can have the short puts pay to buy my calls. But an important caveat here, JC, is I wouldn't put this trade on unless this is a stock A that I love and B I'm comfortable having stock put to me in a worst case scenario. Meaning if the stock sells off and it goes through my short put strike and it gets assigned against me and I become an owner of stock at that strike price, I'm okay with that because I feel good about the stock for whatever reason.
Yeah. And in general, Sean, when you talk about bullish strategies in a high volatility environment, rather than just going out and buying the stock, you certainly don't want to buy the calls naked in a high vol environment. You could just sell the puts naked and just take in. And if you get put the stock, you can get in, right? So in this case, you're taking it one step further and buying the calls too, but either one is good, right?
Right. I mean, this is a more aggressive strategy because by buying the calls, you're giving yourself the potential for unlimited upside. If you're just selling puts, which is also a great strategy when volatility is high and when you're bullish, that trade's going to work out. It's going to have a high probability of success, but your gains are limited to whatever you collected when you sold the put. That's the most you can make in the trade.
But the common denominator is you're cool owning the stock, right?
Yes, ideally, you definitely don't want to be putting this trade on a hot potato that you definitely don't want to be holding.
You don't want to do that in GameStop?
I would not do this in GameStop. No.
All right, let's look at the theoretical P&L graph here on a bullish risk reversal, shorting the puts, shorting the out of the money puts, buying the out of the money calls with that, right?
Right. And here's what I love about this trade. And another part of this trade that I really love is when you put this trade on, let's talk in simple terms here. Let's talk about we put a 2-lot trade on. So we sold 2 of the 90 puts and we bought 2 of the 110 calls. What I love to do, JC, is if and when the market starts moving higher in this, when the stock starts moving higher, let's say it moves up to, let's say 105 on this chart. Well, 2 things are happening. As the stock is moving up, the calls are likely rising in value. And at the same time, those short 90 puts are losing value. And so what I love to do in that situation is whenever I could sell half of my calls, remember I bought 2 calls, right? Whenever I could sell one of those calls and use those proceeds to completely close my short puts, the 2 short puts, I do that, JC, and then I'm just left with a long call that I have for free. How great is that?
It's the best. I mean, you're literally hanging on to a free call option with unlimited profit potential. I mean, I can't think of a better scenario.
And that's exactly what we did. If you move to the next slide, that's exactly what we did in McDonald's in a trade that we did last year. McDonald's, we were very bullish, as you can see on that chart. I mean, what's not to love about that chart? I mean, it looks like it's ready to rip. That was our feeling. And but at the time, I think it doesn't matter what the reason was, but at the time, volatility was priced pretty rich in McDonald's. So I said, well, you know what? Let's use the puts. McDonald's is a stock I'm comfortable owning if it got put to me for whatever reason. It's a company that's not going away anytime soon. So I sold the puts and used those put proceeds to buy calls. And boy, we had quite a run on this one. If you want to move to the next slide, we kind of lay it out. You can see on March 25th, we entered. You could see a very timely entry. And that breakout that happened right before July, we don't have it highlighted on the chart, but you can kind of see where we had a nice little breakout through 200 right before July. During that time, I was able to sell half of my calls to completely close out my put position. At that point, we just rode long calls the rest of that way. And as you could see, it ended up being one of our bigger trades in 2019.
Seems to me like that technical analysis is pretty good there. Huh?
I heard that technical analysis stuff is pretty good. I heard.
One for the good guys. We'll take it. We'll take it. All right, moving right along. Now we turn from green to red, right? The Perma Bulls to the Perma Bears. Bearish in a low volatility environment, which doesn't happen very often, right? Just as a caveat, just to be clear, right?
Yeah, it's as much as we'd love it for it to happen. The problem with being bearish and getting low volatility is that oftentimes, especially you and me, JC, in the way we approach markets, we're getting bearish not because we're calling a top. We're getting bearish because we've already seen an established trend where a stock or an index is trending lower. And when stocks and indices are trending lower, generally people start getting scared and start bidding up the prices of options. And so therefore volatility tends to rise in a bearish environment. So we don't get these types of setups that often as we'd like.
That's us, right? Because we're not top callers, right? That's not who we are. You know, we incorporate other strategies. Not that there's anything wrong with calling tops. If you're looking to call a top, chances are volatility is low, and therefore this is the environment for you. You like to put calendars, huh?
Yeah, I like the put calendar spread in these situations because if you do it out of the money, meaning let's say a stock's trading at $100 and you put a calendar spread on it, say the 90 strike, and a calendar spread, what that means, we should probably explain what that means, is it's a two-legged spread where you are short an option in a near month expiration and you're long the same strike in a further out month. So let's use today's dates. For example, if a stock that I was bearish on was trading at $100 right now, I might put on a 90 strike put calendar spread where I would sell the 90 puts in February options and purchase the 90 puts in, let's say, June options, okay? And why I like this trade is because it gives us 3 ways to win, JC. I mean, gotta love it when you have 3 different ways you can win. We can win simply by just getting the direction right. You know, if the stock sells off, we're likely gonna make money in that trade. If the stock sells off further, volatility is likely to rise, and a put calendar spread will benefit from a rise in volatility. And the reason why is because of the long option that has longer time to expiration. Because there's more time to expiration, it's more sensitive to changes in volatility. So if volatility rises, that long put is going to rise in value a lot faster than the short put that is closer to expiration. And then finally, the late game sell-off. If we get lucky with the timing where the stock sells off, but it never quite gets to our short put strike, or never gets to the short to the strike before the short option expires, and that we get that option gets to expire away worthless, and we're still holding the long put that has a few more months to expiration, and then the big sell-off happens, then we're basically holding a long put that we got at a discount, and gotta love that situation.
And that's for the late game sell-off, or as you said earlier, the choke. You know, like missing a field goal in the Super Bowl or something like that, right? You know?
Oh, you had to go there, didn't you?
I got to give you the Bills did better than the Dolphins this year, like a lot better. So I got to stick it to you when I can, Shawnee. I got to stick it.
You know, wide right still hurts around here.
All right. What about the theoretical P&L graph? And by the way, so in the blue line, we're looking at, you know, current prices. The orange line will be at expiration. DTE, Sean, what does DTE mean?
DTE stands for days till expiration. So I just laid out a theoretical P&L graph for a put calendar spread of a stock that's currently trading at $100. And generally when I put these trades on, well, maybe I shouldn't even say that, but in this case, what I did is I shorted the 30 days of expiration option. So let's say a month out, and then I'll buy one that's at least 2 months out. Sometimes I'll go even longer. I might go 30 days. I might go 120 days. But the important part is that the short option has less time to expiration than the long option. And the P&L graph you see here, the blue line basically shows you how your P&L would trend today. Like if you put this trade on today, it was the middle of the trading day, that's how you can expect your P&L to trend. And that blue line will start to morph towards that orange line as we get closer and closer to expiration of the short option.
Morph, I like that. And,
you like that?
Show you what a piece of garbage this Nikola was last year. We were shorting stocks, or we were shorting this stock, I should say. We shorted Exxon later on in the year too, but we were shorting this stock in particular. It was like our only short within, like, man, I don't know, like a 5-month period or something ridiculous like that until Exxon came along. And this stock was such a piece of garbage that it actually worked in a raging bull market.
Well, not only did it work, JC, but it worked like immediately, and it was actually too good. We actually had to take our time with this trade. We were short the 40 calendar When it sold off to 40 super quickly in such a way and in an unusual way that the short option actually exploded in volatility. It was just a weird situation that was going on. There's a lot of stuff going on in the news with the stock, and you and I don't care about news, but the volatility, and this is a rare situation, but the volatility in the
Isn't this like the Tesla of China or something? No.
no, there was some kind of short seller was out with some kind of crazy news or something and fraudulent accounting or I don't know what it was, but anyway, it sold off to 40, which was what our strike was, or no, we were sorry, it was a 35 strike, I believe it was, but it sold off super fast, and the volatility in the short option actually rose quicker than the long option because it was like considered a temporary thing. Anyway, long story short, we just had to be patient, and we got an opportunity when the stock got down to 35. We closed the whole spread at a profit. It was a glorious trade. It was glorious for the fact that it was like the only stock that was going down in a raging bull market, as you said. So it was especially sweet.
It was like nothing going down. But this came up on our Under the Hood report, which is a scan that we run internally, actually externally. We publish it, it's not just internally. But these are stocks that are showing an unusual increase in investor interest. Like Sean said, maybe it was the accounting. We don't really remember. We don't really care. But it was showing an unusual increase in investor interest. And apparently investors were interested in selling it. All right. The fourth and final environment, Mr. Shawnee, baby. This one is usually, I mean, at least for our strategies anyway, if we're bearish, chances are volatility is already spiking. We're probably breaking down to new lows. Insurance premiums are elevated, etc., etc. Right?
Yes. So in situations like this, there are a variety of strategies you can use, but for me, the one I prefer is a bear put spread. And a bear put spread, quite simply, is you're buying a slightly in the money put, and you're selling an out of the money put against it, and that lowers the cost. It is a debit, so you're paying money out, and that debit represents the most you can lose. Which, by the way, it's important to have a defined risk in this type of environment because, JC, as you know, in a bearish tape, bear market bounces can be vicious.
Yeah. Oh, yeah.
And they can go a lot further than you think they can or should.
The most vicious rallies come in bear markets. If you go back and you go to the Stock Traders Almanac, they always have in the back, they have great data. And they always sort the worst days in history, the worst weeks in history, the worst months in history. Go back and look at look at that data. All of them are in the worst markets of all time, like 87, 29, 08, right?
Yeah. So in these types of environments, I absolutely want to have defined risk trades, and the bear put spread satisfies that requirement to a T. And I really like it because it gives us the opportunity to leverage options volatility skew to our benefit. And that's a word salad to some of you, I'm sure. So let me explain what I mean. Generally speaking, in a normal market, things are a little weird right now, and I can cite some examples. GameStop is one of them, but in a normal market environment, stocks or options in stocks at the lower option strikes in volatility terms are generally priced higher than, say, an at the money option. And the reason that is because Joe Blow on Wall Street or Joe hedge fund who's looking to hedge a large position, they're worried about losing their open profits, or they're worried about their portfolio, whatever the case may be. They're using the options market to hedge their risks, and because of that, there's just constantly a bid in out of the money puts by people looking to protect either their individual positions or their portfolios. So generally speaking, all things being equal, let's say a stock's at $100, and if we go $10 away in either direction, say a $10, 110 call versus a 110 or a 90 put, right? That's $10 away from the current price. The 90 put will be priced sometimes as much as $2, twice as much as that call that's also $10 away from current prices, because people are willing to pay insurance. Basically, that's what a put is, right? It's insurance. They're willing to pay for that insurance, whereas nobody's scared about a stock going up. Rarely. Now, these days, people are very scared about GameStop and stocks like that. They're getting short squeezed like crazy. There's some interesting volatility skews happening on the upside right now. But I'm just speaking generally speaking, in normal market environments, puts are generally more expensive than calls. And so when you put on a bear put spread, we're taking advantage of that by selling that lower strike put, because in volatility terms, that put is more expensive. And that's an edge that it's a small edge, but it compounds in your favor the more you do it.
So guys, I can't emphasize this enough. Like I'm doing this stuff every day. Like literally, Sean and I are on the phone every day, going back and forth. This chart, this strategy, that strategy, and it still gets confusing. And then when you give Sean a couple of beers, and then he starts hanging out with another options trader, and they're going 7 layers deep. I just walk away because I get so confused, right? I'm just like, what? There's so many Greeks between the deltas and the gammas and the thetas and the vegas. I mean, just like, I'm gonna go get beers, guys. Anybody want anything? Like that's my job in that conversation. So for me, like this, like I'm the technical analyst. I'm the one looking at the charts, and then Sean's the one that gets all the charts and then comes up with the ideas. But this is like, just frame it, just like put it on the wall, print it out, tattoo it on your back, like whatever it is that you need to do. But this is such a great resource, Sean.
Well, you're welcome.
Yeah, shout out to Andre who designed this, because Sean and I do not have the skills to design.
Yeah, I wish everybody could have been on our call when you and I were fumbling through making some of these slides. It's comedy of errors when you and I are involved.
If you guys email us, we'll send you the drawing of what this originally looked like before the art guys got there. That was pretty awesome. So anything else that you want to touch on this? Because I know we only mentioned one. We don't need to go into this whole like sub webinar about another strategy here, but anything you want to touch on, point to here?
Well, I mean, we'll reiterate what I mentioned before. These strategies, these 8 strategies that you see here, these are my go-to strategies, the strategies I use most often, but this is by no means an exhaustive list. But I'd say 9 out of 10 trades that I put on are all found right here on this slide.
Yeah. Like I said, I get very confused with options. My head starts spinning. So for me, this is just a great resource, selfishly. Talk about keep it simple, stupid. Listen, guys, if this is something that you're interested, we're going to get into the trade idea now in a minute. If this is something that you're interested, I'm going to drop the link. What we're going to do is, Sean's clients are very wealthy clients, and they're willing to pay $2,500 a year for these option strategies. We're going to knock that off, drop that down to $1,500. Everybody wants to be in options more and more. I mean, these are the highest options volumes of all time, like times 10. Like it's not even close. And the options market ain't going anywhere anytime soon. This is a growing market. There's just going to be more liquidity, more opportunities, and best of all, more ignorance, right? Because as confused as I am, and I do this every day, people are very, very confused, which increases the arbitrage. Having a guy like Sean on the team, wow. So I'm going to drop this into the chat, guys. I encourage you, click on the link. You're going to get access to live monthly conference calls that Sean and I do. We're going over new trades. We're going over existing trades. Sean, Sean, you want to touch on your monthly open trade review? Because I've never seen anybody do something like that. You really do a nice job with that.
Well, thanks. Yeah, once the beginning of every month, what I like to do is I review all positions that I have that are currently open that are approaching expiration. So right now it's February 2nd, right? So I'm looking at all positions that I have on right now that have February expirations, and it's time to make a decision. Is it time to exit the trade and close it down, or is it a trade that we want to watch closely with a trailing stop? And so every month I lay out where we are with the certain open trades and what needs to do, what needs to happen for us to take action. And then we also just kind of recap all the trades that had that month's expiration options but have already been closed. Many of our trades we put on that might have 6 months till expiration, and we actually close it down after we've only been in the trade for 3 weeks because it hit our profit target really quickly, or it hit our stop loss pretty quickly. So we'll kind of recap all that stuff too.
Are these open trade reviews? Is this just you taking victory laps? Is that what's going on?
No, not at all. A lot of the trades that are open, some of them will be losers, and it's like, all right, it's time to cut these out. They're not working. Let's go. And some of them are winners, and some months are better than others. This month in particular, the review is going to be pretty skinny because we only have 2 open trades left with February options. All of our other positions have already either closed out at their profit target or hit their stop loss.
Here's what we're gonna do, guys. Sean was nice enough. Sean's always a really nice guy, but in this case, he's being really nice. And he put together a quick start guide to start trading options like a pro. You know, Sean's a pro. Sean's friends with the pros of pros. Like Sean's like a little too cool for school. He hangs out with like actual market wizards and stuff like that. So when Sean talks about options and trading, you want to shut up and listen. I know I certainly do. I'm known for talking over people. I'm known for talking too much. But when Sean is talking about options, I shut the hell up. I listen. I can tell you from the bottom of my heart how much I've learned from Sean and how much I continue to learn. So today on this particular webinar, we went over one strategy for each environment. As we mentioned, bullish in a high vol environment, bullish in a low vol environment, bearish in a high vol environment, or bearish in a low vol environment. We really dig in. Sean, so by the way, if you sign up for All Star Charts Options Premium to get Sean's trades and our technical analysis, you're going to get this book absolutely free. Sean, why should people be interested in your book? Why should anybody care what you have to say about options?
Well, look, it's a simple to read guide. We talked about it at the top of the call. You and I like to keep things simple, and this book is no different. I try to lay it out in as plain English as I can. The various strategies that I use, how I manage the positions once they're open, and I don't try to kill you with words. We're not talking about 80 paragraph explanations for each strategy. We keep it simple. The team that helped put this book together, put some really great graphs in there. So you have some visuals to work with. I think it came out looking great. I'm a little biased, JC, but I think it looks great.
Well, you certainly did a great job with it. You're a great writer also. So that's not to give you too many compliments, but you are a good writer. You kind of are, I mean, you had a blog before I did. I mean, your blog started what, like 2008 or something like that?
Yeah, that sounds about right. 2009.
I used to read your blog before I knew you. Do you know that? Have I ever told you that? I probably told you that, right?
You could tell me again. It's all right. Sounds good.
This is like on, what was that, Blog Spot or whatever it is back in the
Yeah,
day?
it was on Blogspot. You're right.
See, I remember. So like I said, guys, I've been learning from Sean since before we were friends, and we've been friends for well over a decade, busting each other's balls over, football games and whatnot. Like his 2 favorite teams are the 2 teams that I dislike the most, I think. At
That
least we both agree that we hate the Jets, so we got that going for
and the
us. So
Patriots.
I dropped the link, guys. So sign up for All Star Options Premium. You're going to get the free book, right? But then you're going to get access to the live conference calls, the options trade alerts, and Sean goes into this whole explanation and shares, why technically the team likes to trade and all that stuff. If you don't care, you could just go straight to the options trade ideas and just, see what we're buying, see what we're selling, why we're doing it, and all that. And by the way, it's risk free, right? So risk free meaning you have nothing to lose. Right? So it's not like a call option where you can lose 100% of your premium. In this case, you have no risk whatsoever. If you decide that Sean's options trades are just not for you, just send us an email and we'll send you your money back. It's all good. We just want you to check this out. And by the way, I just dropped the link in the chat. A great added bonus to this is that you can contact Sean or I, or any of the other guys on the team for that matter, or gals for that matter. You can contact Rashmi if you really like, anytime you want, right? Like, so you're not going into this market alone, right? You're going in knowing that we're all in this together. Right? You got Sean, myself, Straza, Rashmi, right? You got the whole team. Any questions you have, shoot it over. And if you have no questions and you just want to say what's up, that's cool too, right, Sean?
Well, I'm glad you said that, JC, because one of the great pleasures I've had, especially in the last year, is customers emailing in, not to praise us or anything like that, but to say, hey, look, this is what I did. I liked your idea, but I did this and I came up with this idea and this is how I did it. And it's a learning experience for me and it's an learning experience for them. I mean, I enjoy that engagement. I think, you know, there's benefits for everybody and I'm happy to do it.
And one of the questions coming in is that, uh, what if I'm new to trading, right? Is it going to be too confusing? Why don't you talk a little bit about how you lay out the plan, first of all, because that's the most important thing. Because the way, I mean, I granted I'm a little bit biased because I do this professionally. I've been doing it for a long time, so I understand things. But let's say I'm entering my first trade. I mean, talk about keep it simple. You literally lay it out. If it does this, we're going to take half off. If it does this, we're proven wrong. We're out of the trade. If it does this, we're taking the final piece. Like, you literally lay it all out. You do a really nice job of that.
Yeah, you know, it's for people who are brand new to trading and have never traded an option contract before. I get it. Options can be scary, right? There's a lot of different terms, a lot of Greek words. Like, what is gamma? What is theta? What's all this weird stuff? It can be scary and overwhelming. And as you said in the blog posts, when we post up a trade idea, I do my best to keep my language simple so that anyone can understand what I'm doing. And we lay out exactly, you know, what price we're going to get in, how we're going to take our profit, when to get out, and why. And look, we have some resources. Obviously, you just talked about the new book, which is just coming out. This is the first time we're offering it, JC. But the new book will be a great resource for you when you're in a trade. If you're in, let's say, a bull call spread and the stock's going your way, what do I do next? Well, you'll be able to reference it in that book, what you could do. Also, as a subscriber to All Star Options, you can email me anytime. If you've got a question about a trade, you don't know what to do, shoot me an email. I'm
And
happy to discuss it with you.
here's the best part, right? So our our readers and our clients and subscribers to All Star Charts and All Star Options, like, we have really smart subscribers. So I don't know about you, but I get some great ideas from our subscribers.
Oh, I agree 1000%. I mean, we just started this year, or I'm sorry, like 6 months ago, we started doing a twice weekly email campaign that we send out to option subscribers. And it's just, you know, it's just me riffing on just top of mind things, not necessarily trading, but things that maybe have a trading, you know, relative to trading. And man, the feedback I've gotten from some of our readers, I mean, on all kinds of topics, is so fulfilling to me. It's so amazing. And man, yes, we have some really smart people engaged with us.
Some people are like, "Oh, if you're so good, why are you selling your research?" And it's like, dude, you don't even understand how much we're winning by talking about the things that we're looking at. Like, are you kidding me? I mean, when we went to India, remember we went to India? I mean, of course you remember, but like, what was it, like, I don't know, 15 months ago or so, we went to India. Like,
Yeah.
how much did you learn in that experience? Like, if we didn't do the things we did, that would have never happened.
Oh man, that was such an eye-opening experience, and even for just me personally, getting to meet active options traders who trade on the Indian stock exchanges, just hearing the way they approach risk and the way they manage risk and their mindsets as traders. There's so many differences, but so many things to learn from, and that was an amazing time.
You want to talk about a nice transition? How about that? Emerging markets. See what I did there?
Oh, I see what you did there. Well done.
Ronan saying that the Japan video that we did was really cool. You like that? That was fun, right?
Oh yeah, looking for candlesticks, which, by the way, we never did find those candlesticks.
We're still looking. We should go back, I think.
I think we need to go back.
I think we need to go back. All right. So let's talk about, okay, we promised everybody at the beginning that we had a trade idea that we wanted to share, maybe even two. We'll see. But we definitely had one. So I swear I'm not clever enough to have talked about India as we go into a conversation about emerging markets. But hey, for the good guys. So emerging markets have been a serial underperformer for a decade. But contrary to popular belief, the market did trade before 2010. I don't know if everyone knows that, but the market's been around for a long, long time. In fact, when JC first got into the business was in the summer of 2003, immediately after the Emerging Markets Index Fund was created. And the first 4 years of my career, emerging markets averaged a 100% return a year for the first 4 years of my career. So you want to talk about JC getting into the business and like all of a sudden I'm like, whoa, emerging markets are the greatest thing ever, right? And then it's been crashing for a decade and people forgot how great that was, but I remember. So where did emerging markets start to outperform? At that exact same level last summer. And we're now making 18-month highs. And now we're looking at monthly candlesticks, Chinese internet, Chinese technology breaking out of multi-year basis to new all-time highs. So from a top-down perspective, from a global macro perspective, from a trend identification perspective, we want to be in emerging markets. We want to be in China. Sean likes the NEO. How's that for an intro, Shawnee? Did we lose Sean? I think we lost Sean. Sean?
JC, you went, there you are. You went quiet there. I think you hit your mute button.
Did I hit my mute button?
I think you did.
Oh, my bad. I had such a great intro. I was talking about how we want to be buying China. We want to be buying emerging markets. Oh, Sanjay said they heard JC. So it was just Sean. NEO. Why NEO?
So, I mean, look, the setup here, I mean, look at that setup. I mean, you certainly can't make a bearish case right there. And what you just said about the emerging markets starting to break out and NEO being in a hot space, I mean, it's electric car makers, right? It's not an electric car maker, but it's in that space in China. Of course, you and I don't care about the fundamentals, so it makes for a nice story, but really that doesn't matter. But what matters is we love this setup. The chart looks great. We're near all-time highs. And boy, from here we got, you guys have a price target of, I don't know, $30 higher from where it's at right now. And looking at the options market, I like a bull call spread here. You know, I didn't want to just buy straight calls because volatility wasn't incredibly cheap. It wasn't onerously expensive, but volatility was not at the cheaper end that I like it to be. And so to hedge my risk and to lower my cost of participation, I like doing a bull call spread here. So we like the August 60-80 bull call spread. What that means is we're buying the 60 strike, which is just slightly out of the money right now, and selling the 80 calls against it. That's a trade that we think has a lot of potential.
Talk about like underselling it. Oh, this is a trade that we think has a lot of potential. Give it to them, Sean. We like this, baby. Come on, electric car vehicles in China. What's sexier than that?
Hey, man, undersell, over deliver.
Fair enough. Fair enough. Speaking of which, so we have a few questions. I'm going to leave this slide up. I'm going to drop this. I'm going to drop it in the chat. As soon as I ask Sean the question, I'm going to drop it in the chat. But guys, you know, this is a huge, by the way, this is never going to be at this price ever again because Sean is absolutely crushing it. I like to think that some of the technical analysis helps, but hey, let's just say the technical analysis sucks. At the very least, Sean's killing it on the option side. Here's the question that we've got. Sean, how do you determine the strike and the month of expiration?
That's a very good question. And it depends on the strategy that we're employing. We touched upon it a little bit earlier when we were talking about long calls. I generally like to buy the 25 delta strike. So whatever strike that is, I want to look for the 25 delta options. Now, a couple of caveats. I want to also make sure I'm getting into a strike that has some liquidity. Sometimes, depending on the stock, there are some strikes, usually like at whole numbers, like say 10, 20, 30, 40, like those big round numbers, they tend to have a lot more open interest and volume at those contract prices versus like say, you know, 45, 55, 65, right? If there's strikes that are split between, you know, one has a 30 delta and one has a 20 delta, I'll pick the one that has the most open interest, only because more open interest means there's more volume, there's somebody else to take the other side of the trade, likely means we'll get a better fill. But I can't fully answer that question for you because it definitely depends on the strategy that we're employing. We haven't even talked about delta neutral strategies here. That's another webinar for another time. But there is some nuance on where strikes are selected. But generally, definitely want to stay in the liquid options. And I want to be where the open interest is. And I generally, if it's long calls, for example, I want to be buying 25 delta calls. But you know, it's a tough. I can't give you a blanket answer on that.
Listen, if you're showing up to our delta neutral webinar, like you're a next level nerd, right? Is that,
then you're our people, is what you meant to say.
we can be friends. Okay, so we said that maybe there was another trade. I think you guys all assumed that there was, and there is. So I don't know if you heard, but JC and the team, we think the commodity super cycle is just getting going, right? You know, when you see crude oil back above all of these lows over the last half decade, you see CRB index, which is energy heavy, back above those 2016 lows, emerging markets outperforming, ags, energy, base metals, maybe even the precious metals join the party. Who knows? I think they ultimately do. Man, I think the commodity super cycle is just getting going, and I don't think investors are prepared, but our friends are. So USO is an exchange traded fund that quote unquote tracks the price of crude oil. I'm not a huge fan of these ETFs, commodities ETFs, but this one's liquid. It's going to give you exposure to oil without having to buy the futures contracts. And by putting an options trade on, I think gives you the exposure that you're looking for into commodities, into energy, and more specifically crude oil. And Shoddy baby, calendar spread, huh? 37 strike.
Yeah, so this is a trade that I'm kind of departing from the norm, at least for me, when I'm putting this one on. I like a calendar spread here, and you'll notice I'm looking at shorting in February, which is, you know, expiring in what, 15 days from now, and buying the January 2022, which seems so far away to say that right now, basically 11 months from now. I'm giving myself 11 months to expiration for that long strike. And so, by the way, we'd be short the 37 strike in February and same strike, long 37 strike in January. And my thinking here is, what I'm going to do is, as this stock moves or this ETF moves, if it moves up, let's talk about if it moves up. Let's talk about the positive. If it goes our way, my plan, as I'm fleshing it out now, is whenever that 37 strike goes in the money, then I'm going to roll that out to the next month, which would be, in this case, you'd roll from February to March, and I would roll it up a strike and do it for a credit. And I want to do that. Let's just have a thought exercise. Let's say USO, of course it'll never work this way, but let's say USO goes up $2 a month from now until January. Well, every month, I'm going to roll that expiring short option that's in the money. I'm going to roll it up to the next month, bring in a little bit more credit, ideally. And every time I bring in a credit, that lowers my net cost of this trade. When we put it on, if we put this trade on tomorrow, it's going to cost us a debit. I think right now you can put the trade on for about $5.50, if I remember correctly, in that neighborhood. Every time we do a roll, that lowers our net cost of the trade. And as we roll the short strike up, we're still long at 37, but now if we're short at, I don't know, 45, 46, as the stock keeps going higher, that calendar spread starts morphing into what looks like a vertical spread that you could sell for a credit. And I know I'm getting all nerdy here, JC, but this will be better explained in a blog post that I'm going to put up tomorrow, which everyone will have access to.
People are asking, they're like, well, when things are moving and we're in real time, is Sean going to be updating us, is what they're wondering.
So great question. That's a question I get a lot. So what we do when we put a trade on is we lay out the steps of what we're going to do and when we're going to take action. Once that is out there, I'll update occasionally on Twitter. I'll talk about the trades. If something major happens, we'll do a quick little email or blog post about it. But generally, everything you need to know is laid out in the first blog post, and then we'll update as we get into expiration month. If the position is still on and it's still working, we'll update on what needs to happen next. But, you know, this is a good meta point to maybe finish with, JC, is all these trades that we put on, these are not trades that need to be micromanaged, okay? We're not watching every tick of the market every day. We're not worrying about every uptick and downtick. That's not the style of trading we're putting on. These are not short-term trades. Now, certainly some trades we get in and out of quickly, but that's never the intention, all right? Look, if a position screams our way the next day after we get into it and hits our profit target, yeah, we'll take it off. I mean, we don't care how fast it gets there. If it gets to our target, we're taking the money and going. But these are not intended to be trades that you need to micromanage. You don't need to get a perfect entry. You don't even need to get a perfect exit. But if you follow the best practices and stick to the plan and stick to the risk management, I think you'll find that these positions are easy to ride.
Some people are wondering how often these trades are coming in. What do you think we're averaging? About three solid trades a week?
Yeah, we do about 3 a week. That obviously will vary based on market conditions. Sometimes we'll do 4 trades in a week. Sometimes we'll only do 2 trades in a week. And the reason we do that is we're not trying to bludgeon you with ideas, right? I mean, there's only so many good ideas out there. We don't want to force ideas on people just because we need to hit a quota. We want to make sure that the ideas we're putting out are ideas that we believe in, ideas that we think have a good chance of making money. And that's our biggest aim. And look, nobody wants to have a portfolio of 50 positions on to manage, even though we're not micromanaging each position. If you have 50 of them on, it starts to become a little overwhelming. I would say on average, for me at any one time, I might have as many as 25 positions on at most and as few as 10 with the strategies that with the trades that we publish here.
And then let's talk about how we're not here to be right. We're only here to make money. So it's not the frequency of success as much as it is that when we are successful, we are making more money than when we are unsuccessful, and we are managing risk responsibly, consistently, which is the idea, right?
Yeah, I mean, look, we're not trying to go for a high win rate here. That's not the goal. When it happens, it's wonderful, but that's not the goal. The goal is to do one of two things.
Stop you right there, because we can have a ridiculously high win rate and just keep collecting pennies. Like, we can do that theoretically, but there are some YOLOs as well.
Right, right. The goal here is twofold. We want to make money in one of two ways. We either want to have a handful of really large winners that make up for a large number of trades that kind of wash out, right? You have a lot of small losers, a lot of small winners, and you have a handful of big winners that make all the difference. Our results certainly show that. That's one way we want to make money. But we also want to make money by putting on a large amount of trades that have a higher than average percentage chance of making money and not losing too much when we're wrong. So we're trying to, put edges in our favor by just, doing a lot of small trades, doing them often, but then occasionally hitting that home run. And look, we do a lot of spread trades, right? So a lot of spreads have not only defined risk, but defined upside, right? There's a limit to how much money you can make. And there's nothing wrong with that. When we do those trades, we do those trades specifically because they give us a higher probability of success. Okay, so it's a balancing act, JC, but we're trying to balance between having trades that have a high probability of success with having trades that maybe have a lower probability of success, but when they win big. That's the balancing act we try to play.
Are you saying that we could be a leadoff hitter that gets on base a lot, and then at the same time we could be at the 4 spot dropping bombs, right?
We can be. When the markets present those opportunities, we can play both sides.
See that? You see what I did there, Shawnee?
I like it.
All right, one more question. When you talk about implied volatility, and I know the answer to this, so I'm just throwing you out of you, but this is a good question. When you're talking about implied volatility, are you talking about the stock itself, or are you talking about the overall market, or both?
9 times out of 10, I'm talking about the individual stock. I don't care overall. I mean, yes, generally I'm always paying attention to what the VIX is, right? And the VIX is the broad measure of fear. across the entire market. I'm always aware of what that is, but when it comes to an individual stock trade, I give 90% of the weight to what the volatility is in that name only. So if we're in a very quiet market, volatility is very low. It's like it's August, right? It's sleepy time in the summertime. Volatility is low, but I'm looking at a stock that's moving like, say, GameStop, for example. It has insane volatility. Well, all I care about is that the volatility in GameStop is crazy. So if I'm going to get involved there, I'm going to be looking at some kind of credit spread where I can sell premium and take advantage of the mean reversion and premium. So definitely 90 to 95% of the weight I place on it, on volatility, is on the individual stock.
I think that's a great question, and we're gonna leave it there, guys. I just want to say what a great crew we had today. Great questions. We don't get this kind of audience for my webinars, Sean. So like you bring the sexy to the options.
Well, the kids love the options, my man.
Kids these days and their options, but it's not just about YOLOing calls and just paying a fortune in premium. We want to do this strategically, right? It's not just a YOLO market. There are times to take in cash as well, right?
That's right. That's right.
So I hope we did a nice job today of laying out our favorite strategies for all kinds of environments, right? Low volatility, high volatility, we're bullish, we're bearish, all of the above. I think there are strategies for all of them. Guys, I'm going to leave this up. Make sure, sign up. I mean, listen, you want Sean's ideas. I'm incredibly fortunate to be able to get his ideas every day, pick his brain every day for years and years and years now. I look forward to learning from you more in the future, Sean. And I hope you guys can learn from him too, because for me, it's really been a treat. So thank you so much for this, Sean.
Hey, thanks for doing this, and thanks for giving me the opportunity to talk to the people. Let's get more people involved, because look, as we talked about before, the more people engage with us, the more we all win. I learn so much from our customers, and I expect that to continue. So thanks.
Give the people what they want.
Right on.
All right, guys. Thanks for being here.
With us now is the king of the technicals, J.C. Peretz.
Joining us from New York is J.C. Peretz.
J.C. Peretz.
J.C. Peretz.
J.C. Peretz.
J.C. Peretz.
J.C. Peretz, All-Star Charts.
I think Warren Buffett would like the way you think.
Just look us up. For example, you've probably gone to Investopedia.com a few times in your day. I'm the one who built their technical analysis course. If you've watched CNBC or Bloomberg or Fox or ABC, CNN, any of these financial networks, I've either hosted my own show or had a regular time slot. You might read me on the Wall Street Journal. I am the most widely followed technical analyst of all time. And the beauty of what we do is that we take what is theoretically a very difficult and complex and complicated subject, and we make it very simple. And we drill down to only the most important parts, selfishly, because we don't like to complicate our lives. So we're not going to complicate yours. We just got back from India. I'm lucky I've been a few times already, but I just wanted to hear it from you. What'd you think?
Oh man, it was awesome. It was so eye-opening, so surprising in all the best ways. The people we met, the food that we ate, the traders that we talked to, especially the traders we talked to. I mean, man, I didn't expect it to leave there feeling completely inspired by the options traders that I talked to out there, but I did.
We talked a lot while we were out there, you and I, a lot of my friends, a lot of people I talked to, I think their impression of what India is, to me, I think is not even close to what India actually is. I think there's some misconceptions out there from Americans. Were you surprised at all by the sophistication of some of these traders? Did you kind of have that, well, in America, we're more sophisticated than everyone else sort of attitude? Were you open-minded?
Yes, I was surprised at the sophistication of traders out there. Every trader that we encountered out there had a level of sophistication that maybe surpasses some of the levels of sophistication that I encounter with on a regular basis here in the United States.
Let me ask you this, of all the meetings we had a ton of meetings in 5 days. Like, talk about a full schedule for our Mumbai experience. What do you think about the technical analysis community, right? So you were at a CMT event in Mumbai. Did that sort of surprise you, or was it kind of what you thought it was going to be?
Oh man, let's talk about that CMT event for a second here. I mean, you and I have both attended CMT events here in the US, and they're always great. They're kind of as you would expect them to be. The event was top notch. I mean, it was everything. And of course, it goes without saying, the food. But it far exceeded my expectations, and I hope I'm not letting the cat out of the bag. But we're thinking about filming a documentary about the Indian trading experience.
What would you tell people out there who are like, you guys are going to India for what? Like, they don't really understand what goes down out there. What would you tell people?
I think just go with a good attitude and a can-do spirit, and you will have a great time. I have no doubt about it.